Hey, business owners, welcome again to another live stream with me today. My name is Lunta Di La Paulo, and I'll be sharing with you one very important subject, that is, how do you analyze your revenue and client base to maximize your bottom line? Okay, so we're gonna be looking into some of the very important questions, like how do you know whether or not you know your client base. We're also going to be asking questions like what clients contributes the most to your revenue, to clients that contribute the least to your revenue, and also looking into other measures of client profitabilities, as well as whether or not you should keep certain clients or let them go for the goodness of your company, of your marketing agency, of your firm. Okay, so I'm gonna go ahead and share my screen with all of us today so that we can start our conversation. Okay, so let me quickly share my screen, and then we're gonna get going. How's that? Okay, I hope you can see my screen. And again, we're gonna be covering the analysis around revenue and client base in order to maximize the bottom line. Okay. So our roadmap, just to give you a little bit of our overview, our journey today in the next 30 minutes or so. First of all, we need to gain an understanding of the client base, right? Before we move any further around the analysis, we need to know, okay, who are the clients and how much they are bringing to the company. And from there, we can do a further analysis, okay? If you're looking to sell your business, especially, one of the key questions that a potential buyer will immediately ask will be around customer concentration, right? The higher the client concentration is, the less valuable your business becomes, right? If you have one or two large clients that contribute more than 30% each of to your total revenue, that's a big problem. Okay. And some business don't even know that they have certain clients that contribute the majority of their revenues. Maybe they know what is that on a theoretical basis, but they don't actually know the numbers, right? So this exercise is so important because it helps us understand the level of risk our business carries, so that we can then take active steps to correct that risk, to minimize it to a comfortable level. Okay. And after we do our assessment, we'll move into prepare, where we will use the assessment report and to drive our keep versus firing decision of certain clients. Okay. And then lastly, after we have done that step, then we will move into the implementation of the new client-based strategy, right? We'll look into, okay, what's the ideal client we want to maintain in our firm, in our agency, in our business? Because the type of client we have are typically going to bring similar type of clients. Okay, if you build your business with the type of clients who are giving you a lot of headaches, they're gonna, their network is more likely made up of people like them, and they will refer your business to other people like them, and therefore they can compound the smaller problems you have today. So we're gonna look into that. So let me go into my Excel workbook to show us how that analysis actually is done. Okay, so we have a set of data here that we're gonna be using to run our analysis. First of all, most businesses, okay, will have the following column: the client or account name column, the employee covering that client or account, the revenue that client brings, and maybe they will have this column, okay? The service purchased. by that client, the geography of that client, okay? And that will be it, okay? Let me maximize a little bit here so that we can better see this. And that would be it. And based on that, a lot of companies can run things like the percentage of revenue a given client contributes to the company, right? So client one, for example, contributes 3.64%, right? And we can see if we had to run a quick summary on that or analysis here, we can determine the top 10 client easily, okay? But that information is incomplete. Just knowing the amount of revenue a given client bring to the firm is not a good measure to determine whether or not the work with a given client is actually profitable, okay? So let me show you what else can you do with your client and revenue information, okay? So here's where our analysis will begin. Number one, we need to have an idea of what's the variable cost of servicing a given client. So for example, client one brings about $40,000 per year to the firm, and the variable cost to service this client is $3,000. Okay. That means our contribution margin for this client is 37,000. But that's not all. Okay. We need to allocate the cost per employee covering that client. So for example, John Doe, the salaries and benefits paid, when we prorate that cost to this client, we assign $1,500 of the annual salaries and benefits of this client to client one, meaning our fully burdened profitability is actually $35,000 with some change, right? That gives us a net profit margin of 88%, 88.75%. Okay. So from there, we can clearly now look, we can now see some interesting trends in our presentation or our client information. We can notice that there are a lot of smaller client, especially when we look at the bottom, that actually cost the firm a little bit more money, right? They are at net, cumulative net $5,000 to service them, than they bring to the company, right? So we can also see here the net loss these clients individually are contributing to the firm. These analysis, and let's just see these 13 clients, how much they contribute to revenue. It's less than 1% of the revenue, right? But they are costing the firm in aggregate a little over 2% approximately, right? So we also see that based on this information, we can clearly see, okay, who are the winning clients here, right? Which clients are bringing the highest net profit margin. And from there, we can actually start to think about, okay, what are the clients that we are allocating significant resources that are not contributing much to the firm, and which client we should be allocating a little bit more resources based on the profit contribution they bring to the firm, okay? And that information is so helpful because sometimes companies get lost at servicing clients that are dead weight loss, okay? When a business owner is allocating so many resources, so much resources to a client that is not generating enough to the business to justify that decision, that's usually not a good business um, decision, okay? Because the moment you, as a business owner, start misallocating your resources that are limited, you are more likely to start losing money. Okay. If that repeats itself many months or years, sooner or later, you're not gonna be in business. Okay. So this is the reason it's so important to know what's the cost of servicing certain certain clients, and whether or not the amount of resources the business allocates to these clients is justifiable. Okay. It's not a good idea to staff highly valuable employees to low value clients. Okay. And some of you who are following this might think, well, why would a given client be low value? Okay. Uh, Not all clients are equal in value for a given business, right? Some clients, their value may not be monetary, right? They may not be bringing a lot of income to your firm. I have these kind of clients, but they are great at generating referrals to our firm. So their value is not only based on how much they bring to the firm, but how much additional income they help us generate. Okay. So it's important to be cautious in our analysis around the clients. For example, maybe what client 91 is a low income client, but brings us a lot of referrals of high value, high ticket clients. Okay. So this is number one part of our analysis. The second thing that we need to make sure of is to analyze the budget revenue. Okay. Many companies do not necessarily have a budget revenue for each individual clients. Their revenue projections or forecast or estimates is out of the vacuum, right? If a client last year generated, let's say, $35,000, and you expect to increase their service fee for, let's say, 10%, you can accurately estimate how much you expect to get from that client in the following year. So when we build revenue pro formas for clients in our firm, we actually try the best we can to marry each potential existing client and new clients into that projections that we are building. Okay. So that allows us to conduct the variance analysis for the client. Okay. So for example, we were expecting to get 25,000 from this client, and the actual revenue ended up being 40,000. We have a positive variance of 15,000, which is 35%, 37% more. Okay, what does that mean to us? What drove that increase in revenue for that specific client? Okay, we need to ask question whether it's a good or bad variance. One question that we can ask ourselves in our firm or our team uh, is this revenue increase sustainable? Can we expect to see the same level of revenue increase next year, for example? Okay, that's a very important question to ask. Another important question is to think about, okay, what led the increase in revenue from this client? Is it because we increased the our fees to this client, or were there other factors like the client is growing faster and they are therefore increasing the demand for our product or service? Okay. So for example, we're providing SEO service to this client and we're expecting a 25,000 revenue. Maybe we upsold them another service that helped increase another $15,000 in revenue. Okay. So we need to ask all these good questions. Okay. The other level of analysis we are also interested in running is whether or not we are at risk of losing a given client. Okay. We all know when a relationship with a client is risky, is becoming vulnerable, maybe they're not satisfied for about something. So we really need to do this exercise at least once every 3 months to make sure that we are not we're not gonna be caught with a big surprise of a client wanting to leave the firm. Okay. And a part of the reason we run this analysis, especially for your top 10 clients, for your most important client, is to ensure that your revenue base is stable, is predictable, and there's not going to be significant fluctuation. Okay. So always ask yourself, okay, is client one at the risk of loss? Okay, no. Okay, why not? What is giving us confidence that this client is not gonna leave us in a foreseeable future? Okay. If yes, okay, what's making this client more, what could potentially make this client leave the firm? Maybe our level of service have declined. Maybe the client is not satisfied with the level of service we are providing to them. Maybe we're not um, we have difference in our expectation around the scope of the work, maybe other reasons out there. So understanding this problem can help you approach the client and have a conversation around, okay, how can we make this better? Okay. I'll share with you, some of the hard conversations that I had with some clients. Some clients simply wanted me to do their bookkeeping, but I also understood that that's not where the value really lies with their business for their business, right? A lot of business owners see bookkeeping simply as, a must-have cost for their business. And we in our firm, we believe that adding some level of CFO service to them would be beneficial to them. Having quarterly meetings to meet with them to discuss the financial, developing projections, creating goals for the team to go around building a more sustainable business, to build systems around their business would make them a better business. And unfortunately, the business owner did although they understood the value in what we were proposing to them, they just didn't have the budget to uh, to pay for it. So, we just decided that it wasn't going to be something we were no longer interested in doing. We don't want to keep clients who are not willing to work on their own business to grow so that they can continue in business. Therefore, we also have really good clients around for a more longer period of time. And that difference was big enough for us to, split our ways and go separate ways. So very important question to ask for each one of your clients. And we also have a scoring mechanism here, right? That determines whether the client is at average or higher. And this formula, we have created it based on the level of profit that the client brings to the company. Okay. And the other items we have developed here are qualitative uh, formulas that help us come with a customer rating. Okay. This customer rating allows us to do that second piece, right? Deciding whether or not we're going to keep certain clients or let them go so that we can start restructuring our client base according to the profile of client we want to work with moving forward. Okay. So some of the qualitative items we came up with was the enjoyment to work with the client. They are, we're not gonna get along with everybody, and some clients are unfortunately a pain to work with, and some clients are just amazing to work with. They give us creative experience, they give us joy to work with. But other clients, they don't treat well your team, they don't respect your employees, they're always late in sending critical information. They make you they try to force you to work out of scope without compensating you fairly. These clients are not gonna be, they're not gonna receive full point. Maybe they're gonna receive 1 point or 1.5, right? We also have timeliness to pay. Some clients are good with their financial management and they always pay on time or even before the due date. Other clients wait after the due date to pay you, right? So there is a scoring mechanism there. Communication effectiveness, right? Is the expectation of communication clear, right? How clear is it, the communication, and so forth. So making sure, you have a scoring mechanism. Maybe you have other standard of that you consider value that we can add here in our assessment of clients. But for us, these based on interviews with clients, those are, really the key, the key, the key metrics a lot of our clients shared in common around what they would use to value or to classify their customer. At the end, we have a formula here in our column T that really tells us the rating of each customer based on a number of factors that we ran in our analysis. Okay. So once we have done this analysis, right, we have a dashboard here that tells us that provides to us some of the key uh, some of the KPIs around our customer base. For example, we can see here our revenue by service provided, right? We're using an example of a marketing agency. We have outsourced CMO bringing 9%, contributing 9% to our firm. We have paid ads 41%, which is the largest revenue generator. We have social media manager 37% and SEO 12%. We also have revenue by employee. It seems like Jane Doe is the winner here, bringing over 60% of revenue, covering client that generates about 60%. And then we have our top 5 clients by revenue. Okay, we have client 13 that clearly generates the most revenue to the firm, and then client 17, and then the rest of them. Outside of that, we have revenue by state, right? It seems like Michigan is the breadwinner of the firm here in terms of geography, okay? And lastly, we have our revenue, our customer rating classification. It seems like the firm's revenue client base is made up largely by B class type client and 32%. And then we have about 2% that is C type client. The big question now becomes, okay, what do we do with this information? Of course, we have a summary here, right? The key takeaways of our client base. But coming back to this customer rating, the goal really should be, hey, look, we have about 2/3 of our clients that are B client. What can we do to bring at least half of them to A and transition this 2% from C to B, right? Because we want to have largely A type of client and a little bit of B type of client, and ideally very low, very few C-type client customers. Okay, C-type customers, excuse me. So with this information, now we are actually ready to start making really critical decisions. Maybe we can approach the C-type client and maybe just let them go if they are not gonna be willing to do the work to get them to at least B-type clients, right? And for our B-type client, we can approach them with a conversation to understand where there is a gap in our expectation of them and where they are and what can we do to help them get to A-type clients. Okay. These analyses helps us really get a sense of where our company is today, but also in the future, right? There is one thing that I haven't talked about here, but depending on your industry, the age group of your client can be a major factor as well. For example, in our profession, accounting industry, if if a business owner has a firm that has let's say 70% and the CPA practice that has 70% of its client base over 65 years of age or plus, that could be a big risk factor to that firm, because a lot of the clients who at some point were coming for bookkeeping work, business advisory or tax preparation work are getting closer and closer to retirement. And the demand for these services will drop. And if they drop, so does the revenue of the company. So I haven't added it here, but it's a very important item to add here, right? So watch out about some of your clients who are near the exit, or who need to start thinking about succession plan and so forth. So I wanted to do this quick live to share with you this piece of information. I'm gonna stop sharing my screen here, right? So if you have any question, if you need help from us, please let me know. Let me go back and just to share my contact information here for you in case you need to reach out to me, to my team. Okay. So here's my contact information. Again, my name is Lunta Di La Paulo, and we run a CPA practice. We cover clients across the US, across the nation, and now we're starting to touch a little bit international clients as well. So reach out, feel free to contact me. Here's our main website. If you want to get our free ebook, our PDF, around 7 financial mistakes that marketing agency make that can make take them out of business, please download here in our website, luntadilapaulo.cpa.com/7mistakes. And you can contact me either through my phone number or my email address. And again, I'm gonna stop here. It's been a pleasure being here with you in this short live. Let me know if you need help with anything. Happy to staying in touch. Cheers.